In early February 2026, Oracle made an announcement that sent shockwaves through Wall Street and Silicon Valley. The enterprise software giant revealed plans to raise between $45 and $50 billion within a single calendar year through a combination of debt and equity sales. To put this in perspective, that's more money than most countries spend in a year. It's larger than the entire market capitalization of companies like Ford or General Motors. And it's happening not because Oracle is in trouble, but because the company claims to have so much customer demand that it literally cannot afford to meet it without fundamentally reshaping its entire financial structure. Oracle says it has over $523 billion in contracted cloud infrastructure commitments sitting in its backlog, with some of the most powerful names in technology waiting in line. OpenAI, Meta, NVIDIA, TikTok, and Elon Musk's xAI have all signed massive deals. On paper, this looks like the ultimate validation of Oracle's strategic pivot. But when you start pulling back the layers, what emerges is something far more complex and far more precarious than a simple growth story. This is a company that spent decades perfecting one of the most profitable business models in enterprise software. And it's now abandoning that model entirely to make what could be the biggest and riskiest bet in modern corporate history. Welcome to Chart Chamber, where we unpack the financial strategies, the hidden risks, and the economic forces reshaping our world. Today, we're diving deep into Oracle's unprecedented $50 billion gamble, exploring why a company with a legacy of stability and profitability is suddenly willing to lever itself to levels that would make most CFOs lose sleep at night, and what this reveals about the broader transformation happening across the technology industry. So let's start with what Oracle actually announced. In a press release issued on a Sunday afternoon in early February, Oracle stated that it intends to raise $45 to $50 billion during calendar year 2026. Roughly half of this capital will come from equity, including mandatory convertible preferred securities, and a new at-the-market equity program worth up to $20 billion. The other half will come from debt, specifically a single large issuance of investment-grade senior unsecured bonds. Oracle made it clear that this money is earmarked for one purpose: building out massive cloud infrastructure to meet the contracted demand from its largest customers. The announcement was unusual in its timing. Major corporations rarely make capital-raising announcements on Sunday afternoons unless there's a compelling reason to do so. Some analysts suggested that Oracle's management was trying to stabilize the stock price, which had been in free fall for months. Others saw it as an attempt to reassure bondholders who were growing increasingly nervous about the company's ability to finance its ambitious plans. To understand why this announcement matters so much, you need to understand what Oracle used to be. For decades, Oracle was the definition of a cash cow. The company sold database software and enterprise applications with extraordinarily high profit margins. Once you built the software, the incremental cost of licensing it to additional customers was minimal. This meant that profits flowed almost directly to the bottom line. Oracle used that cash to do exactly what investors wanted: buy back shares, pay dividends, and make strategic acquisitions. The company had a conservative balance sheet, strong credit ratings, and a reputation for financial discipline. It was the kind of stock that pension funds and institutional investors loved because it was predictable and reliable. But then the cloud revolution happened, and Oracle found itself in an uncomfortable position. Amazon Web Services had invented the cloud infrastructure market and dominated it. Microsoft Azure came next and quickly became the second major player. Google Cloud poured billions into catching up. Oracle was late to the party, and for years it struggled to compete. Its cloud business grew, but it remained a distant fourth in a market that seemed destined to be controlled by just 2 or 3 giants. Then something unexpected happened. The artificial intelligence boom created a new dynamic, and Oracle saw an opening. Training large language models and running AI inference at scale requires enormous amounts of computing power. It also requires specialized infrastructure, with high-performance GPUs, ultra-fast networking, and massive power capacity. The hyperscalers, Amazon, Microsoft, and Google were all building out this infrastructure, but they were also using it for their own AI products and services. This created a potential conflict of interest. If you're OpenAI or Meta or xAI, do you really want to run your most sensitive AI workloads on infrastructure owned by a company that might also be your competitor? Oracle positioned itself as the neutral provider. It promised that it wouldn't compete with its customers on AI products. It would simply provide the infrastructure they needed with this performance, security, and scale they required. And it worked. Oracle started signing contracts that dwarfed anything it had done before. The most significant of these was with OpenAI, the company behind ChatGPT. In September 2025, Oracle announced a deal with OpenAI worth an estimated $300 billion over 5 years. That single contract represented more revenue than Oracle's entire annual business at the time. Meta Platforms committed to expanding its AI workloads on Oracle's cloud. NVIDIA, the chipmaker at the center of the AI revolution, became both a customer and a technology partner. TikTok, facing regulatory scrutiny and data sovereignty concerns in the United States, turned to Oracle for critical infrastructure. Elon Musk's xAI needed massive compute capacity to train its Grok models and signed on as well. By early 2026, Oracle reported a backlog of $523 billion in remaining performance obligations. That's contracted revenue that customers have committed to pay, assuming Oracle can actually build the infrastructure to deliver it. And that's where the real story begins. Building cloud infrastructure at this scale is nothing like selling software. It's one of the most capital-intensive businesses in the world. You need to construct or lease massive data centers. You need to purchase tens of thousands of servers and GPUs. You need sophisticated cooling systems, redundant power supplies, and high-speed networking equipment. You need to negotiate power purchase agreements because these facilities consume electricity at rates comparable to small cities. And you need to do all of this before your customers start paying you, because they won't pay until the infrastructure is online and operational. Oracle found itself in a paradox. It had demand that most companies would envy, but it didn't have the cash flow to meet that demand without fundamentally transforming its financial model. So Oracle made a decision. It would raise the capital externally and use it to build out the infrastructure as quickly as possible. The $50 billion capital raise would give Oracle the firepower it needed to fulfill its backlog and establish itself as a credible third player in the cloud infrastructure market. But this decision comes with profound financial risks, and the numbers are startling. As of early 2026, Oracle's debt-to-equity ratio has climbed to over 400%, according to several financial analysis sources. That means Oracle now has more than $4 of debt for every dollar of shareholder equity. To put that in context, Amazon's debt-to-equity ratio is around 50%. Microsoft's is even lower. Alphabet, Google's parent company, has virtually no net debt. Oracle is operating at a level of leverage that's extraordinarily high for a technology company, especially one that still holds an investment-grade credit rating. Why does this matter? Because debt creates fixed obligations. When you borrow money, you have to pay interest every quarter, and eventually you have to repay the principal. Those obligations don't disappear if your revenue falls or if your customers change their plans. The more debt you carry relative to your equity, the more vulnerable you become to any disruption in your business model. Oracle is betting that its customers will honor their contracts, that AI demand will continue growing exponentially, and that it can generate enough cash flow from its cloud operations to service its debt and eventually pay it down. But if any of those assumptions prove incorrect, the financial consequences could be severe. There's another dimension to this that makes the situation even more precarious. Oracle's free cash flow, the actual cash the company generates after capital expenditures, has turned deeply negative. According to Bloomberg data, Oracle isn't expected to return to positive free cash flow until sometime between 2029 and 2030. That means for the next 3 to 4 years, Oracle will be burning cash. It will be spending more than it brings in. This is the opposite of the business model that made Oracle successful for decades. For years, Oracle was a machine that generated billions of dollars in free cash flow every quarter. Now it's consuming cash at a rate that would have been unthinkable just a few years ago. The company has effectively taken on the financial profile of a high-growth infrastructure startup, but with the legacy obligations and investor expectations of a mature enterprise software company. The bond market noticed this transformation immediately. In early December 2025, Oracle's credit default swaps, which function like insurance contracts that pay out if a company defaults on its debt, spiked to levels not seen since the 2008 financial crisis. Specifically, Oracle's 5-year credit default swaps climbed to around 139 basis points, more than tripling from where they were just 6 months earlier. This doesn't mean Oracle is about to default, but it does mean that investors are pricing in significantly more risk than they used to. It's a clear signal that the market is concerned about Oracle's ability to manage its debt load while simultaneously funding one of the largest infrastructure build-outs in corporate history. Then, in mid-January 2026, the situation took another turn. A group of bondholders led by the Ohio Carpenters Pension Plan filed a class action lawsuit against Oracle in New York State Court. The lawsuit alleged that Oracle had failed to adequately disclose the extent of additional debt it would need to raise when it issued $18 billion in bonds in September 2025. According to the complaint, investors who bought those bonds were blindsided when Oracle returned to the capital markets just 7 weeks later to secure $38 billion in loans for data centers tied to the OpenAI agreement. The bondholders claimed that the offering documents for the September bond sale were false and misleading because they didn't reveal that Oracle was already organizing to raise massive additional debt. When news of the additional borrowing became public, the value of the September bonds fell sharply as investors reassessed Oracle's credit risk. The lawsuit seeks unspecified damages and names not only Oracle and its leadership, but also the major banks that underwrote the bond offering. This legal action added another layer of uncertainty to an already complex situation. It raised questions about Oracle's disclosure practices and whether the company had been fully transparent with investors about the scale of its capital needs. More broadly, it highlighted the tension between Oracle's aggressive expansion plans and the expectations of fixed-income investors who had purchased the company's debt under the assumption that Oracle was a stable investment-grade credit. Meanwhile, Oracle's stock price tells its own story. In early September 2025, Oracle's shares hit an all-time high of over $345, briefly pushing the company's market capitalization above $930 billion and making it the 10th most valuable publicly traded company in the United States. The surge came after Oracle announced its massive backlog in the OpenAI deal. For a brief moment, it looked like Oracle had cracked the code and positioned itself to become a foundational player in the AI economy. But that optimism didn't last. By late January 2026, Oracle's stock had fallen more than 50% from its September peak, erasing approximately $460 billion in market value. The decline accelerated after Oracle's December earnings report, which showed weaker than expected revenue and revealed that the company was raising its capital expenditure forecast for fiscal 2026 from $35 billion to $50 billion. Investors interpreted this as a sign that Oracle's infrastructure build-out was going to be even more expensive and take longer than originally anticipated. So why is Oracle doing this? Why is a company that spent decades perfecting a low-risk, high-margin business model suddenly taking on levels of financial risk that make even seasoned Wall Street analysts uncomfortable? The answer comes down to strategic conviction and competitive urgency. Oracle's leadership, including founder and chairman Larry Ellison, believes that artificial intelligence represents a once-in-a-generation technological shift comparable to the rise of the internet or the move to mobile computing. They believe that the companies that control the infrastructure powering AI will be the most valuable and strategically important companies of the next decade. And they believe that if Oracle doesn't make this bet right now, it will be permanently locked out of that future. There's logic to this thesis. The cloud infrastructure market is consolidating rapidly. The capital requirements are so high that smaller players simply can't compete. If you can't invest tens of billions of dollars in infrastructure every year, you can't serve the hyperscale customers that are driving the market. Oracle sees a narrow window of opportunity to establish itself as the third major cloud provider, behind Amazon and Microsoft, but clearly ahead of everyone else. The $50 billion capital raise is designed to slam that window shut in Oracle's favor before competitors can catch up or before its key customers decide to build their own infrastructure. But this strategy rests on several critical assumptions, and each one carries significant risk. First, Oracle is assuming that its customers will actually follow through on their contractual commitments. A $523 billion backlog sounds impressive, but contracts can be renegotiated, especially if circumstances change. If OpenAI decides it makes more economic sense to build its own data centers, or if Meta shifts more of its AI workloads to in-house infrastructure, or if regulatory changes force TikTok to restructure its operations, Oracle's backlog could shrink. And if the backlog shrinks, Oracle is left holding billions of dollars in specialized infrastructure and a mountain of debt with no clear path to profitability. Second, Oracle is assuming that AI demand will continue growing at its current explosive pace. Right now, every major technology company is racing to build larger models, run more experiments, and deploy AI at scale. This is driving unprecedented demand for compute capacity. But there are emerging signs that this growth trajectory might not be sustainable indefinitely. Some researchers argue that we're approaching the point of diminishing returns in model scaling, where simply making models bigger doesn't necessarily make them proportionally better. Others point out that the cost of training and running these massive models is becoming prohibitively expensive for all but the largest, best-funded players. If AI demand plateaus or shifts in a direction that requires less raw infrastructure, Oracle's entire strategy could be undermined. Third, Oracle is assuming that it can execute this build-out efficiently and on schedule. Building data centers at this scale is extraordinarily complex. There are global supply chain constraints for critical components like high-end GPUs. There are power availability issues in many markets, with some regions unable to provide the electricity these facilities require. There are regulatory and permitting hurdles that can delay projects by months or years. Oracle is racing against time to get infrastructure online before its customers lose patience or find alternatives. Any significant delays, cost overruns, or technical problems could erode margins and push the timeline to profitability even further into the future. And fourth, Oracle is assuming that its competitors won't simply outspend it or undercut it on price. Amazon, Microsoft, and Google all have stronger balance sheets, more diversified revenue streams, and deeper cash reserves. They can afford to operate their cloud businesses at lower margins, or even at a loss in the short term because they have other highly profitable businesses generating cash. Oracle doesn't have that luxury. Its traditional software business is mature and growing slowly. If the hyperscalers decide to defend their market share by engaging in aggressive price competition, Oracle could find itself in a war of attrition it can't win. Despite these risks, Oracle does have some genuine advantages that support its strategy. The contracts Oracle has signed with its major AI customers aren't typical pay-as-you-go cloud agreements. They're long-term commitments, with significant upfront guarantees and penalties for non-performance on both sides. These aren't handshake deals or letters of intent. They're legally binding contracts with real money behind them. Oracle's customers need this infrastructure desperately, and they've put substantial commitments on the table to secure it. That gives Oracle a degree of revenue visibility and certainty that most cloud providers don't have. There's also Oracle's positioning as a neutral infrastructure provider. Amazon competes with almost everyone in some capacity, from retail to streaming to advertising. Microsoft is building its own AI models through its investment in OpenAI and competing directly in the productivity software market. Google is deeply invested in AI research and deploying its own AI products across its ecosystem. Oracle, by contrast, has made a deliberate strategic choice to stay out of the AI application and model business. It's focusing exclusively on providing infrastructure. For customers who view the hyperscalers as potential competitors or who have concerns about data privacy and competitive intelligence, Oracle's neutrality is a real and valuable differentiator. It's not just marketing. It's a structural advantage that could matter a great deal as AI becomes more central to competitive strategy across industries. But even with these advantages, the financial mechanics of Oracle's bet are daunting. The company is effectively running two parallel businesses that operate on completely different financial models. One is the traditional software business, which still generates the majority of Oracle's revenue and operates on high margins with predictable cash flows. The other is the nascent cloud infrastructure business, which requires massive capital investment upfront and won't generate positive returns for years. Managing this transition without destabilizing the entire company is an extraordinary challenge. Oracle has to keep its software customers happy and its legacy business healthy, while simultaneously executing one of the largest infrastructure build-outs in the history of corporate America. There's a useful historical parallel to consider here. In the early 2000s, telecommunications companies made massive leveraged bets on building out fiber optic networks. They borrowed heavily, convinced that demand for bandwidth would grow exponentially, and that whoever controlled the physical infrastructure would dominate the market. Some of those bets paid off spectacularly. Others ended in bankruptcy and industry consolidation. The difference often came down to timing, execution discipline, and whether actual demand materialized at the scale and speed that justified the investment. Oracle is making a structurally similar bet today, just in a different market with different technology. The fundamental principle is the same: borrow now, build big, and hope that demand catches up before the debt becomes unsustainable. What makes Oracle's situation particularly fascinating is the broader context of corporate finance in 2026. Interest rates have been volatile over the past few years as central banks have struggled to balance inflation concerns with economic growth. The cost of borrowing has risen for many companies, making highly leveraged strategies riskier and more expensive. Oracle is entering the debt markets at a time when investors are increasingly cautious about high leverage plays in technology. The fact that Oracle is moving forward anyway suggests that its leadership believes the opportunity is simply too large to pass up, even if the financing environment isn't ideal. There's also an important competitive dynamic at work that often gets overlooked. By raising this capital and committing to this build-out, Oracle is effectively forcing its competitors to respond. If Oracle succeeds in establishing itself as a credible third cloud provider with massive AI infrastructure, it could siphon meaningful market share from the hyperscalers and disrupt the competitive equilibrium that's existed for the past decade. Amazon and Microsoft can't ignore that threat. They may have to accelerate their own investments, adjust their pricing strategies, or find other ways to defend their positions. In that sense, Oracle's bet isn't just about its own future. It's a strategic move designed to reshape the entire cloud infrastructure landscape and force a redistribution of power in the industry. So what are the possible outcomes here? In many ways, they're almost binary. In the optimistic scenario, Oracle executes flawlessly. It builds out the infrastructure on time and on budget. Its customers honor their contracts and continue expanding their AI workloads at the expected pace. Demand for AI compute continues growing robustly, and Oracle's neutral positioning attracts even more customers who are wary of the hyperscalers. The company's cloud revenue grows rapidly, eventually offsetting the massive capital expenditures and debt service obligations. By 2030, Oracle is generating strong positive free cash flow again. Its debt-to-equity ratio starts to decline, and the market rewards the company for its boldness. In this scenario, Oracle's $50 billion bet looks like a visionary strategic move that transformed the company and positioned it for a decade of profitable growth. In the pessimistic scenario, something goes wrong. Maybe AI demand doesn't grow as fast as expected. Maybe one or more of Oracle's major customers renegotiates their contracts or shifts to in-house infrastructure to save costs. Maybe there are significant delays or cost overruns in the build-out that push the timeline to profitability further out. Maybe the hyperscalers launch a sustained price war that squeezes Oracle's margins to unsustainable levels. Or maybe the broader economic environment deteriorates, making it harder for Oracle to refinance its debt or raise additional capital when needed. In this scenario, Oracle finds itself overleveraged and underperforming. Its debt becomes increasingly difficult to manage. Its stock price continues falling. The company is forced to scale back its ambitions, sell assets, or potentially even seek a merger or acquisition to stabilize its balance sheet. The $50 billion bet, instead of being remembered as visionary, becomes a cautionary tale about the dangers of excessive leverage and misreading market dynamics. The reality is that we won't know which of these scenarios plays out for several more years. Oracle has committed to a path, and now it has to execute. Every quarterly earnings report, every customer announcement, every infrastructure milestone will be closely scrutinized by investors, analysts, and competitors. Every delay in data center construction, every contract renewal, every shift in AI spending patterns will be analyzed for clues about whether Oracle's massive bet is paying off or starting to unravel. What's already clear is that this represents a fundamental shift in how we should think about corporate strategy in the age of artificial intelligence. For years, the conventional wisdom in technology was that software companies should avoid capital-intensive businesses at all costs. The whole appeal of software was that it scaled beautifully without requiring proportional increases in capital investment. Oracle is now doing the exact opposite. It's deliberately moving into one of the most capital-intensive businesses imaginable because it believes that's where the strategic value lies in the AI era. It's willingly sacrificing near-term profitability and financial stability for the chance to be a foundational player in what it sees as the next wave of computing. This raises profound questions about the technology industry more broadly. If Oracle, a company with decades of experience, strong competitive positions in multiple markets, and deep relationships with enterprise customers, feels compelled to take this kind of risk, what does that tell us about the AI infrastructure market? It suggests that the barriers to entry are extraordinarily high and getting higher. It suggests that only companies willing to make massive, highly leveraged bets can compete at the scale that matters. And it suggests that the AI revolution, for all its promise and potential, is also creating a more concentrated, more capital-intensive, and arguably more fragile technology ecosystem. There's also an interesting dimension for Oracle's customers. Companies like OpenAI, Meta, NVIDIA, TikTok, and xAI are all in different businesses with different strategies, but they share a common need for massive compute infrastructure. By outsourcing that infrastructure to Oracle, they're able to focus on their core competencies, whether that's building AI models, running social networks, designing chips, or creating consumer applications. But they're also creating a dependency. If Oracle struggles financially or can't deliver on its commitments, these customers could face serious operational disruptions. That's a risk they've apparently decided is acceptable, but it's worth noting nonetheless. As we watch this story develop over the coming years, it's important to remember that financial bets of this magnitude are rare precisely because they're so difficult to execute. They require unwavering conviction, disciplined execution, significant amounts of luck, and a fundamental alignment between strategic vision and market reality. Oracle's leadership has made the case that the AI infrastructure market is large enough, durable enough, and strategically important enough to justify the risk. The market is now testing that thesis in real time, with billions of dollars and the future of one of technology's most storied companies hanging in the balance. Whether Oracle emerges from this as a visionary that successfully navigated one of the most challenging corporate transformations in modern history, or as a cautionary tale about the dangers of overreach and excessive leverage, will depend on countless variables, many of which are outside the company's direct control. What we can say with certainty is that Oracle has fundamentally changed its identity. It's no longer primarily a software company that happens to offer cloud services. It's now an infrastructure company betting its entire future on the continued exponential growth of artificial intelligence. That transformation, regardless of how it ultimately ends, is one of the most significant strategic shifts in recent corporate history, and its implications will be felt across the technology and financial sectors for years to come. If you found this deep dive valuable and want to stay informed on the strategies and financial forces reshaping the global economy, make sure to like this video and subscribe to Chart Chamber. We'll be following Oracle's journey closely as this story continues to unfold, because this is just the beginning of what promises to be one of the most compelling corporate dramas of our time.